The production of this program is made possible thanks to the support of the following and viewers like you. Vancouver's housing market is dramatically different than it was 12 months ago when the provincial government stepped in to ensure affordable and ample housing. In a Conversations Live panel in March of 2025, Burnaby Mayor Mike Hurley indicated it didn't work. In fact, the housing market is upside down. What happened? Why is the market behaving this way? And what can we expect to have come next? Perhaps central to understanding the answers to those questions is to appreciate the word uncertainty. The ongoing trade uncertainty with the United States, the uncertainty associated with a new federal government, and uncertainty over the way in which provincial regulators are affecting the market. Ryan Berlin of Rennie Co. has been examining the broader forces at work in the market and why it is moving in such unexpected and uncertain ways. He says the factors at work include the economy, interest rates, rising household debt, demographics, government immigration policy, migration, and a reformation of the construction sector. I invited Ryan Berlin to join me for a Conversations That Matters about the uncertainties and what Rennie has identified about the Metro Vancouver housing market. Ryan, welcome.
Thanks, Stu.
Uncertainty is the word, isn't it? Like, it's uncertainty almost across the board.
It is. I mean, and it's a we think about the last 3 months as it relates to the new U.S. administration and their, frankly, idiotic approach to, an unpredictable approach to trade policy. But we've been in a 5-year cycle now. I mean, we just marked 5 years since COVID landed on our shores. And there were lots of ups and downs in there. And, there was a feeling, looking back over the past couple of years and, especially over the past year, that we saw the light at the end of the tunnel in the sense that we weren't dealing with rising inflation that, when it hit 8%, we didn't know that was the peak. We were wondering how high it could go. We didn't know how high interest rates were going to go. So we saw those curves sort of crest and return to levels that we were accustomed to. And it gave us a sense of stability and predictability. That's all perception, because you really don't know what's coming down the pike. Is there another pandemic? Is there, a trade policy, an unpredictable trade policy that is going to, make everyone sort of step back and want to wait? And I mean, that's what's happened. So if you look at the end of 2024, I would say if we look at the housing market, I wouldn't say it was in great shape, but it was at the point where we started to see a little bit more activity. It was like, buyers were coming out of the woodwork and sort of tiptoeing in, and, if the home made sense for them, they would do it. We didn't have there was no speculative activity. There was no real opportunistic buying, but we saw a return almost to typical levels. Not quite, but through Q4 of last year, we saw some year-over-year increases in sales. That continued into January.
So those are positive signs.
Those are positives, yeah, because it wasn't an overheating market. We were coming from a real nadir in terms of activity. So it was really just moving back to what was considered typical. And we didn't quite get there when February came along. And all of a sudden, threats were made about tariffs being applied to all, from the US to exports from all countries, including Canada. And everyone then starts having conversations about, well, what does this mean? What does it mean for my job? What does it mean for the cost of living, inflation, interest rates? And no one had a good answer. I mean, we still don't have good answers. So then
the reaction is to say, I think I'll sit tight.
Yeah. Why would you jump in? Why would you? Right. So if you're an individual buyer, you're in the market for a home. Why would you take that leap now when you don't know if the value of your home is going to at least hold steady in the near term? You don't know if in 5 years, when you go to renew your mortgage, you don't know if you'll be facing higher interest rates. For 40 years leading up to COVID, that wasn't the case. You could predictably renew your mortgage every 5 years, lock in for 5 years, renew at a lower rate, a lower outstanding balance, your payments went down. It was great. Mm-hmm. And then all of a sudden, it was like once bitten, twice shy with this, the increase in inflation on the back end of COVID through 2021 and 2022. and higher rates. And all of a sudden people are renewing at higher rates, or they're stuck in a variable rate mortgage that they can't get out of. And so we saw negative amortizations in mortgages, right? So I think it was a bit of a reality check for people. And now that scenario, you can't preclude from happening again.
Well, the other thing that I noticed in your report is you're saying, okay, for a number of people who jumped in at COVID because literally had historically low interest rates that were frozen, and they went, okay, now's the time to leap in. Well, those are coming due now. And those mortgage rates are 2.5%, maybe even 3% higher than what they bought in at.
Absolutely. I'm one of those people. It's that is a reality. I think for some of us, we knew that this was it was a moment in time, that this was not the new baseline for rates. I think the concerning part there is for households that took on maximum leverage at that time that rates were at a minimum. And so, they may have been stretching themselves then, and now, you're looking at rates that might be close to triple what they were paying previously, right? So, no, the reality is, I think it's too simplistic to just say, hey, your payments went up, therefore you're in deep trouble.
Right.
Because over a 5-year period, for one thing, if you're managing your finances in a reasonable way, you are paying down that principal. But you're also, for the typical person, not everyone, but typical person, and often homeowners, over a 5-year period, you are seeing an increase in wages. Like, we've seen pretty strong wage growth over the past 5 years, like between 3% and 5%, right? And that's just sort of consistent, growth in earnings. But, it's reasonable to think too that people, you get promoted in that time, and so you could experience income jumps. And I'm not saying that's everyone's scenario, but that is part of the equation as well. Regardless, it is more expensive to own a home today than it was 5 years ago.
Well, and in looking at your report, bring in the uncertainty about what the economy is going to look like right now. And that affects buying behavior. Absolutely.
So, you are just not going to make the biggest purchase of your life when you don't know what the future looks like, or you don't think you know. It's really just about perception, right? So, if you're nervous in this environment about your job, having a job, or you're looking at inflation and thinking, well, these tariffs, like, I don't know where this trade war is going to go. And it's possible that we really start to see these tariffs manifest as not just higher prices, but consistently higher prices, right? So that inflation now has become a longer term issue that the bank must respond to, the Bank of Canada must respond to with higher interest rates. And, we're already seeing bond yields, which really drive fixed mortgage rates, that the tail on that come back up. So, we're not in dire straits, but we're in a moment where it's really like, is this the calm before the storm, or is this going to get sorted out? And in which case, once it's sorted, we'll get back in. Now, I will say about that is I don't see any solution short term, any reconciliation in these trade agreements with the US bilaterally that they have with any country, including Canada. I don't see any resolution that brings immediate certainty. I mean, we have a president down there who negotiated the current iteration of CUSMA that replaced NAFTA back in 2018. He said it was the greatest trade deal in history, and now it's the worst trade deal in history.
Yeah, saying that we ripped them off.
We ripped them off. So I'm not sure that you can necessarily trust what you see and hear. So,
if I can just jump in here, when we were sort of looking at Trump coming in, maybe Trump 2.0, I had come across something from former New Jersey Governor Chris Christie, who's not a fan of Trump, but he was in Canada talking about what you could expect from Trump. And he goes, I'm a little bit surprised that you're even asking that. You have to recognize how Trump has functioned. He even pointed out in his book, The Art of the Deal, this is how I function. I go to the absolute outer edge of where I would absolutely love it to be, and maybe a little bit further, so that I'm going to drag you closer to a settlement point, that I'm happy with than you are. And so he said the rhetoric versus the outcome, like you can't actually put the two together.
No.
He says you have to take a look at his legislative record. The problem is it's the rhetoric that has created so much uncertainty and a strong emotional response that also includes, okay, I'm afraid.
Absolutely. And I totally agree. And I think that there is, what he's demonstrated seemingly as well is a lack of understanding of the impacts that one decision may have elsewhere in the economy. And, it's been said that he's playing, his supporters say he's playing 4D chess. And I say, I think he's playing 1D checkers because there is no long-term plan. He wants to negotiate and he wants a win when it comes to every trade deal that he's in the midst of discussing with other countries. He wants a win. But I think he didn't consider when he introduced quote unquote reciprocal tariffs. Of course, they weren't reciprocal, but that initial iteration of them and then pulling back on them, but then threatening countries and jacking them up on China, that would have the effect of really worrying the markets. One, that's going to hit the bottom line of companies that trade in international markets. And so it wasn't surprising that we saw the stock market come down. Yep. And then what he didn't expect, I'm sure, was that the bond market started to suffer. And that's a big problem for him, right? So we saw yields go up rather than down because people said historically, in times like these, if it wasn't the US at the origin of the uncertainty, the one driving it, you would have countries, investors, everybody flocking to the dollar and buying US government debt and driving those yields down. But this time it came from within the US. So people said, every actor on the world stage said, I don't know if that's should we be investing there? And so this is where now I think he has the pace of the rhetoric, if you will, has slowed. And I think part of that is there are people in his ear saying, hey, listen, there are some real repercussions here to, it's not the tariffs, but it's the lack of clarity on the tariffs. That is the issue.
And so it's interesting for us to be having this discussion about what the impact on the Metro Vancouver real estate market is. But there's a real and direct link because it creates that level of uncertainty.
I know, you wouldn't think it, right? You wouldn't think little old us here. I mean, there's 3 million of us in this region, but this, this outpost, relatively small in the southwest corner of Canada, seeing its housing market impacted so much. We're seeing it across the country, to be fair. This is not a Vancouver thing solely. But it is, and it's not even just buyers that are on the sidelines. It's anybody that's investing in anything. Whether you're a company who maybe you had hiring plans and maybe you go, well, I actually don't know what my book of business is going to look like in 6 months, 12 months. And so maybe you just pause on that. You don't necessarily invest in new equipment and technology right now. And for developers as well, it's very hard to make that leap. You may have already acquired the land. You may have been ready to go to bring a new 300 home tower to market and sell that into the market. And now you go, well, I actually don't know if I can sell it.
Right.
And so you don't release it. And we're seeing that sort of pullback on supply.
Well, with the financing laws the way that they are, it is difficult for a developer to say, okay, I'm going to hit a certain threshold of pre-sales that are going to confirm that I can get through because of the timelines that are there. What changes are at work there, or what are the constraints that are affecting the market right now?
I don't know if everyone knows that when in British Columbia, that when you bring a, let's call it a multifamily project to market before it's built, so as a pre-sale, you're working within a limited time frame to market and sell a certain proportion of those homes, call it 60%. And within that period, it had been 12 months up until recently, you'd have to sell, around 60% by revenue of your building. And then, your financial partner would then, give you money to start building.
Yeah.
And so, I mean, that is how the market works. And when the market is fluid and you have more typical levels of activity, it's reasonable to expect that most of the time you can achieve that. Now, projects have gotten a lot bigger over the years, 60% bigger in terms of number of homes. So BCFSA, which is responsible for that, is consumer protection legislation, the Real Estate Development Marketing Act, which specifies you have 12 months. They've now extended that to 18 months, recognizing primarily it's less of a response to the economic conditions and more a response to the fact that the nature of development, the scale of these projects has changed. And so if you have a building that's at least 100 units, you can apply for an additional 6 months. You still have 18 months to sell. Now, this is still very much like that situation in Temple of Doom right? Where Indiana Jones is trying to get under the wall as it closes.
Right.
And that's what it is. You have that period to sell the number of homes you need to trigger financing, or else all of your buyers can walk away if they choose. So, you're really in a market like this where you have buyers who are extremely hesitant in resale, not to mention pre-sale. It's just, for these larger projects, we're just not seeing them actually launch and come to market.
So what the restrictions around foreign buyers, how much has that affected that pre-sale market?
Well, listen, I think it has. That isn't the only thing. So I think what we engineered housing policy to work when there was always somebody that wanted what was being offered, whether it was something for sale or something for rent. We implemented restrictions on short-term rentals last May throughout the province because we said that there were tenants looking for long-term leases. We said no to foreign buyers federally. One definition of the foreign buyer, they were banned. Back in 2016 in this province, we implemented a tax on a different definition of foreign buyers. What we've done is primarily we've altered that risk-reward relationship. We have discounted the amount of risk that is involved in real estate as a buyer, as a developer, as an owner. And we've said, hey, that reward you're getting, we want some of that. Or maybe you should get less.
Or you don't deserve it.
Yeah,
that's a part of that too.
Fundamentally, that is what it is. And so there's just, at the end of the day, not acknowledgement for the amount of risk that exists. And it's easy to overlook it when the market is up. When there's not enough supply, there's more than enough demand, and values are rising. But right now, we're not getting homes built. Like you see a lot of cranes because what you're seeing built now was sold a couple of years ago.
Right.
That's going to dry up really quick.
So do you think that as the rental supply increases, rents are now coming down, could we see a return to saying, okay, you can put that property back out on the short-term rental?
Maybe that's a question for somebody else. I mean, from a practical perspective, I would say we should be encouraging a degree of investment activity. And we also have a flipping tax. Right. We have a speculation and vacancy tax. We had an increase in the capital gains inclusion rate for a period of time, not really, which won't be in place anymore. But it was sort of like we had all of these parameters in place where it's like if you held on to your asset for too long, you'd pay a tax. If you didn't hold on long enough for the flipping tax, you'd pay a tax. And so I just think that we have the market in a vice grip from a policy perspective. And I think what I would want to make clear is that for the long term, you can look right now and say, oh, we've got all this supply and not any demand. Sure, this is a blip in time. So if we just look medium and long term, we need more housing. And our housing in this region comes in the form of multifamily homes. So whether it's townhomes or it's 4 to 6 story wood frame or it's 20 to 50 story concrete. And investors have been a catalyst to that housing being delivered in a physical form. And we've seen, if I look at our own data, as we're a sales and marketing company, we work with dozens of developers, sell thousands of homes. In 2021, 2, and 3, about half of the buyers in the projects that we sold were investors. And these are just everyday people. For many of them, it's their only investment property. The rent doesn't actually cover the mortgage, but they're hoping in the long term it makes sense. So they're taking a risk. But they help to catalyze that new supply. We saw the investor share of purchases fall to a quarter in 2024, and through the first quarter of this year, it's down to 7%. So, I think, again, I go back to my statement about engineering policy to fit a market where there is, you can call it infinite demand, but enough to not have that vice grip, be applied to the market. We've done that, but I think we need to look at more adaptive policy, and maybe that means pulling back on some of these things where it's like we actually do need supply. So how do we encourage that?
Right. So last point here, we've only got about 2 or 3 minutes left, is to talk about the impact of the changing in immigration laws and what's happening within internal migration in Canada and the effects that it's having on this marketplace.
Right. So we are headed into, or we might be in, a so-called demographic no man's land. And that's only half true because there's also no women. So all that is a bit of an overstatement, but what I'm referring to is the fact that we have seen tremendous population growth over the past few years, and really unconstrained growth. And as a result, the federal government's immigration plan has been updated. So in the fall of last year, we said, no, we still want immigrants, permanent residents, but instead of targeting 500,000 this year and next, we're going to reduce it to less than 400,000. That over the next 3 years, fewer than 400,000 immigrants is less than we've seen in each of the past 4 years. So it is a pullback, but it's still 30 to 40% more than we've seen historically. So it's still a big number. It's not the reason why we're going to see a paradigm shift in our demography.
Okay.
What the government also said is, beginning in the spring of last year, I believe, was they put a cap on international student visas. And then they expanded that and said, we want non-permanent residents, which includes students and temporary workers, as a share of our population to be 5% by the end of 2026. Well, we're at 7.5% today. There's 3 million people in that category in this country. So we have to reduce that by 1 million. So call it 500,000 this year and next year. To put that in context for you, and I mean, that will yield overall population decline. We don't make babies in this country. There's no policy that I'm aware of that will help us, reshore the manufacturing of little people. So we have a natural increase not contributing to growth. International migration is the source of our growth. Yeah. So we're reducing temporary residents by 500,000 a year. We have 100,000 immigrants, and our permanent resident targets are coming down. That equals a decline. I don't usually cite data going back to the 19th century. If you go all the way back to Confederation, there's not a single year between then and now that we've had population decline in this country. And we're going to see 2 in a row, equivalent to about 0.5% of our population each year.
So the government can meet the targets
to meet the target. We'll see if the political will is there now. We had an election yesterday. So we'll see if that political will remains to commit to that target, because that's a dramatic shift.
Right, because the new Prime Minister, Mr. Carney, has indicated that he wants to see the Canadian population continue to grow.
Yes, and that isn't necessarily incompatible with this policy, because he might mean in the fullness of time. I mean, our models show the population growing beginning again in 2027, but for the next 2 years, it's a real headwind to consumer markets, the rental market, which is great for tenants in this region, but it's going to be hard for developers to bring new supply to market.
All of which leads to uncertainty in the market. Thank you. We're out of time, but thank you for coming in and giving us some insights into this. And I really encourage people to read your report.
Thanks, dude. Appreciate it.